in the final month of last year, inflation took an unexpected turn. As the calendar flipped to December, the economic forecasters were left scratching their heads. The inflation rate, you see, had jumped higher than anyone had predicted. Key figures rolled in and painted a picture of an economy in flux. The Consumer Price Index, a key measure of inflation, had surged, signaling an unexpected acceleration in the rate of price increases. Now, what were the factors at play here? Well, a multitude of elements contributed to this increase. Supply chain disruptions, labor shortages, and increased consumer demand during the holiday season all played significant roles. These factors combined led to an inflationary environment that was more intense than anticipated. But the real question on everyone's lips is this: what does this mean for our economy? To understand the impact, we need to put this inflation increase into context. In the grand scheme of things, inflation is a normal part of economic growth. A certain level of inflation is expected and even necessary for a healthy economy. However, the recent inflation increase has surpassed expectations, raising eyebrows among economists and financial analysts alike. Let's rewind a bit. Over the past few years, inflation has remained relatively steady, with minor fluctuations here and there. But this December's increase came as a bit of a shock. It outstripped both the predictions of economists and the trend observed in previous months. Economists and analysts had their eyes on a gamut of factors that could potentially trigger inflation. These included labor market conditions, international trade, and government spending. Yet, the magnitude of the rise in inflation caught many off guard. Here's an interesting point to ponder. While economists can predict trends and analyze data, the economy, in reality, is a complex beast, influenced by a multitude of factors. Unforeseen events, such as natural disasters, pandemics, or political upheavals, can cause ripples that affect the whole economic landscape. Such a surge in inflation doesn't occur in a vacuum. It is a reflection of broader economic dynamics. For instance, increasing demand for goods and services can push prices up. Likewise, any disruptions in supply chains can cause a spike in the costs of production, which then translates into higher prices for consumers. Inflation is often likened to a thermometer of the economy. It measures the health of economic activities and can indicate potential issues lurking beneath the surface. When inflation rises more than expected, it's a signal that something in the economy is heating up. And here's the crux of the matter. Inflation is more than just an economic indicator. It's not merely about percentages or indices. Inflation is a phenomenon that impacts real lives, from the price of a loaf of bread to the monthly mortgage payment. Inflation is more than just numbers. It has real-world impacts. Inflation isn't just an economic term. It affects our daily lives. Now, let's take a moment to think about how inflation impacts our day-to-day. When inflation rises, the cost of goods and services tends to climb as well. This means our hard-earned dollars don't stretch quite as far as they used to. Imagine this. You're at your local grocery store. Your shopping cart is half full of the same items you purchase every week. But this week, you notice the total at the checkout is higher than usual. The price of milk, eggs, bread, all the staples has gone up. You haven't bought more, but you're paying more. That, in essence, is inflation in action. Or consider this. You're planning a family road trip. You budget for gas, food, and accommodation. But as you start to fill up your tank, you realize gas prices have skyrocketed. That trip just got a whole lot more expensive. Again, that's inflation, quietly eating into your budget. Inflation can also impact bigger financial decisions. Maybe you're considering buying a house. With inflation, your dream home may seem just out of reach as prices rise. The cost of materials for construction has increased, and this is reflected in the selling price. The same goes for education. The cost of tuition continues to rise year after year, making it more challenging for families to afford. Even your morning cup of coffee isn't immune. When inflation hits, the cost of coffee beans goes up. This means your local cafe might have to increase the price of your favorite latte. But let's not forget, inflation isn't all doom and gloom. For some, like borrowers, a certain level of inflation can be beneficial. If wages increase with inflation, then the real value of debt decreases. That's a potential silver lining in the cloud of rising prices. However, the key is balance. Too much inflation can lead to economic instability, while too little can signify a stagnant economy. But it's not just individuals who are affected, businesses feel the pinch too. And that's where we'll pick up in the next scene. Stay tuned. Businesses are at the heart of our economy and they're directly affected by inflation. Let's unpack this a bit. When inflation increases, businesses are often faced with higher costs for raw materials and labor, which are the building blocks of their products or services. This can squeeze profit margins, especially for those industries that are unable to pass these increased costs onto their customers. A classic example might be the restaurant industry, where patrons might balk at suddenly higher menu prices. But it's not just about the immediate cost of goods or labor. Inflation can also impact a business's ability to invest and grow. You see, when inflation is high, interest rates typically rise as the central bank attempts to cool down the economy. This means borrowing money becomes more expensive, which can stifle business expansion or investment in new projects. However, it's not all doom and gloom. Some businesses may actually benefit from inflation. Those with the ability to pass on higher costs to their customers, or those dealing in commodities whose prices rise with inflation, can actually see their profits grow. It's a bit of a balancing act, and the scales tip differently for each business. Inflation also affects the business environment in more subtle ways. Uncertainty about future inflation rates can make long-term planning more challenging. If, for example, a business is unsure how much their materials will cost 6 months down the line, they may hesitate to make long-term investments or take on new projects. Furthermore, high inflation can erode consumer purchasing power, leading to decreased demand for non-essential goods and services. This can hit businesses hard, especially those in the retail, hospitality, and leisure sectors. So, as you can see, inflation's impact on businesses is multifaceted, affecting everything from costs and profits to planning and consumer demand. It's a complex web of cause and effect, with the potential to both hinder and help different sectors. So businesses are feeling the effects, but what about the wider economy? Inflation doesn't just affect individuals and businesses, it has macroeconomic implications too. Let's put it this way. Think of the economy as a vast interconnected web, where each strand represents a different sector: individuals, businesses, and government. When inflation tugs at one strand, it reverberates through the entire web. So how exactly does inflation impact the wider economy? Well, it's a bit of a balancing act. On one hand, a moderate level of inflation is generally seen as a sign of a healthy economy. It suggests that demand for goods and services is high, which can stimulate economic growth. Businesses might respond to this demand by ramping up production, potentially leading to increased employment. Sounds pretty good, right? But hold on to your hats, because there's another side to this coin. If inflation rates climb too high, they can actually hinder economic growth. How so? High inflation can erode purchasing power, causing consumers to cut back on spending. This, in turn, can lead to a decrease in demand for goods and services, prompting businesses to scale back production and potentially leading to job losses. And let's not forget about government policy. Central banks use interest rates as a primary tool to control inflation. If inflation is high, they might raise interest rates to slow down the economy and cool off inflation. On the flip side, if inflation is too low or if there's deflation, they might lower interest rates to stimulate spending and investment. So, as you can see, inflation is a bit like Goldilocks porridge. It's a question of getting it just right. Too little, and the economy could stagnate. Too much, and it could overheat. But here's the real kicker. Inflation isn't just a domestic issue. It can have international repercussions too. High inflation can devalue a country's currency, affecting trade and potentially leading to economic instability. So, what can we expect in the future? Well, that's the million-dollar question. But one thing's for sure. Understanding the macroeconomic picture is key to navigating the complex world of finance. Inflation is a dynamic process, and it's always changing. As we look to the future, the question on everyone's mind is, what's next for inflation? Economists and analysts offer a variety of predictions, all influenced by a range of factors. Let's start with a key point. Predictions are just that, educated guesses. They're based on current data and historical trends, but the future is always uncertain. Economists use complex models to forecast inflation, considering elements like fiscal policy, market trends, and global economic conditions. But remember, These models are not crystal balls. They simply give us a possible glimpse into what might unfold. Many experts anticipate that inflation will continue to rise in the short term. Why? Several reasons. First, supply chain disruptions are still causing ripples in economies worldwide. This leads to increased costs for goods and services, which are then passed on to consumers. Second, high energy prices are pushing up the costs of production, and again, these costs are often passed on to consumers. However, it's not all doom and gloom. Some analysts believe that inflation will eventually stabilize and even decrease. They argue that as supply chain issues resolve and energy prices stabilize, inflationary pressures will lessen. Additionally, central banks around the globe have tools at their disposal to curb inflation, such as increasing interest rates. Yet other factors may be at play. Climate change, for instance, is expected to have a significant impact on inflation in the coming years. Severe weather events can disrupt supply chains and increase the costs of food and other commodities, leading to higher inflation. In conclusion, predicting inflation is a complex task that involves a multitude of variables. It's a delicate balancing act between a range of factors from supply chain disruptions to energy prices and even climate change. Inflation is a key economic indicator, and it's something we all need to keep an eye on. As we move forward, it's crucial to stay informed and understand the potential impacts of inflation on our everyday lives. After all, knowledge is power, and with power comes the ability to navigate the ever-changing waters of the global economy. That's all for today's video on inflation. We appreciate your time and interest in understanding economic trends. Don't forget to like this video, subscribe to New Way Finance Academy, and turn on notifications so you never miss an update on the latest financial news.